Hello, happy holidays, and thank you for joining us today, December 27th, for our fourth quarter 2021 Market Touchstones slideshow. My name is Paul Latta, and I'll be doing the narration today, but my business partner, Baj Kochar, and I are both available for questions and discussion. Our contact information is on our website at cedarrivercapital.com. We've been doing these brief video market updates on a quarterly basis, basically since the onset of COVID and the related quarantines and social distancing early last year. We hope you find the video updates helpful in understanding what we regard to be the most important factors in the capital markets today. With that, let's go ahead and begin the slideshow. Our agenda today is a slightly different format from prior slideshows. We begin today with a few slides that visually summarize the present market situation as well as the main macro factors that are driving the markets. And then we present a top 5 list of the most pressing debates about the future direction of the markets. And then we'll finish with a few concluding thoughts. So far this year, the S&P is up just over 27% through near the end of December 2021. It's a solid performance given that the average performance over the last 50 years is about 10% per year. So it's a very solid performance. Main driver has been accommodative central bank policy. Also, there's been some optimism about either putting the pandemic behind us or just simply learning to live with COVID. Markets have been a bit choppy in the last 4 months of the year, mainly due to fears around the COVID variants, in particular the Delta variant in late summer, and the Omicron variant beginning in late November. We'll talk about these factors and a few other details in subsequent slides. We were hoping to not discuss COVID in this quarterly update, but the new Omicron variant, like the predecessor Delta variant, is again driving capital markets, so it is again the elephant in the room. This chart shows U.S. COVID infections over the last couple of years. There's a bit of an inconsistent sine wave pattern, with the first peak of size being the seasonal peak last year of the original Chinese strain. That was followed by the late summer peak of the Delta variant, and it appears another surge is forthcoming with the Omicron variant, which has already lifted infection rates in Europe and Africa. University of Washington is forecasting Omicron to peak in the U.S. in late February, but with a fairly wide band of uncertainty. Omicron appears to be more infectious but less deadly, but virologists are still learning about the new variant. There are many ways to slice and dice the stock market, by industry sector, by geography, by investment style, by market cap size. This slide looks at investment returns by the style factor. Interesting that the fourth quarter to date looks much like the third quarter, with the notable exception of momentum stocks moving from the top of the stack to near the bottom of the stack. This partly reflects Omicron-induced volatility not being a good environment for a strategy that depends on stability, and right after a top of the market performance in the prior quarter. So the reversion does make sense for momentum stocks. As in the prior quarter, the market drew a very bright line distinction between conservative growth and aggressive growth. Conservative growth, which is dominated by the 5 mega cap tech names, Facebook, Apple, Amazon, Microsoft, and Google, performed well, with investors being drawn to the ongoing growth with or without COVID, and their blue chip status creating a flight to safety draw on down days, valuations that are elevated but not outlandish. In contrast, the aggressive growth style, or story stocks, was again under pressure in the fourth quarter, as it has been in the prior 2 quarters. The ongoing softness in story stock reflects 3 factors. First, story stocks are taking a rest after the breathtaking returns in 2019 and 2020. Second, story stocks trade at highly elevated valuation and hence are more vulnerable to new risk developments such as new COVID variants or increasingly hawkish Fed policy. Third, the corporate finance pipeline is intimately tied to story stocks, and with 700 plus new SPACs and IPOs in 2021, far eclipsing the all-time high of the 1999 dot-com bubble, there's now more story stock supply than story stock demand. And story stocks will not stay here in the basement forever, though a rapid reversion seems unlikely. In our investment letter from a year ago, we discussed at length the $7 trillion question related to central bank quantitative easing. Today, the assets on the Fed balance sheet are closer to $9 trillion, as you can see here. Good news is that the Fed is tapering its bond buying program, and the taper accelerated earlier this month of December, with the target completion date now of March 2022. So this chart ought to flatten out shortly. However, the chart is not likely to drop anytime soon. The last go-around with quantitative easing starting in 2008 saw ongoing starting and stopping of bond buying, but did not actually start selling bonds until 2018, as you can see in the chart here. Granted, this time around is a bit different since inflation is a more serious threat due to pandemic-related supply chain disruptions. Still, hawkish central banks are likely to begin with rate increases before they start selling their accumulated bond assets. Moving from the Federal Reserve to the Treasury now, this slide shows U.S. federal debt as a percentage of gross domestic product. We mainly put the slide here for visual context since we alluded to the modestly declining debt levels in prior slideshows, but without the visual, there was a little bit of confusion. So this chart actually shows that debt levels did indeed peak at just over 135% of gross domestic product in the early days of COVID, but has since moderated to about 122% of GDP as of the third quarter. This is still a very high level by historic standards, though it's actually not too different from other G7 countries with the exception of Japan. Japan runs a much higher level. While the modest decline in the elevated debt level is a silver lining, it should also be mentioned that rates are near zero, so the interest burden on the high debt level is not as egregious as one might expect when looking at only the total debt chart. We'd now like to move on to the second part of our presentation, which is a top 5 list of the most pressing debates about the future of the capital markets. There are dozens of pressing debates about the future of the global capital markets, but here we've curated a top 5 list of what we believe to be the most important discussion points, as listed here. The 5 slides that follow will provide a little bit more detail on each of these 5 bullet points. We'll start, of course, with the first bullet point, which is the debate about the Omicron impact versus the Fed hawkishness. It is a little curious with the onset of Omicron just after Thanksgiving that the Fed is becoming more hawkish rather than more dovish. After all, the initial onset of COVID in March of 2020 led to the kickoff of the Fed's quantitative easing program, now at nearly $9 trillion. So this is number 5 on our top 5 list. Why would the onset of the most infectious COVID variant yet result in the complete 180 at the Fed? In a word, it's inflation. The initial onset of the pandemic in March 2020 led to a deflationary collapse in demand and the need for central banking support. But the onset of Omicron variant is happening in a world that has been increasingly accustomed to living with COVID, yet a world that is also becoming desensitized to supply chain disruptions, real or perceived, that are driving inflation higher. In essence, the Omicron threat is bigger for supply than it is for demand, so the Fed flip-flopped and is now hawkish. The Fed is not alone, as you can see in the slide here. Indeed, most central banks around the world have abandoned quantitative easing. Only the US, Europe, and Japan are still easing, and the US and Europe central banks are in the process of tapering their quantitative easing programs. In recent weeks, we have seen our first rate increases from developed OECD countries like England and Norway in particular. Does the increased hawkishness mean we are headed into stagnation or worse, stagflation? In the near term, any economic slowdown is not likely engineered by the Fed, but rather Omicron. Indeed, US tapering has moved long-term rates lower, not higher. Still, the consensus is once the Fed finishes with its taper in March, it will then lift rates 3 times over the course of 2022. While that will still likely keep short-term rates below 1%, the headline perception of hawkishness will likely keep overall market exuberance at bay somewhat in 2022. Over the last century, there have been dozens and dozens of inflationary bouts in countries around the world. Inflation is tough to fight. The hallmark of high inflation is a weak currency. The US in the 1970s, for example, saw a sharp decline in the value of the US dollar after going off the gold standard in 1973. Inflation in the US soared in the 1970s. Today, we are seeing hyperinflation in Turkey as the Turkish lira collapses. Venezuela has also seen enormous inflation since the collapse of the bolivar in 2014. The tie between inflation and currency is powerful. But today in the US, we are seeing the impossible. A very strong US dollar and at the same time an inflationary surge not seen since 1980. This conundrum is number 4 on our top 5 list. Granted, we are talking 7 to 9% inflation here in the US, not the 1,000% inflation of Venezuela. But still, a strong currency and a strong inflation are generally regarded as mutually exclusive. You cannot run backwards and run forwards at the same time. Yet the trade-weighted US dollar is now within 4% of its all-time high. Clearly, the inflationary pressures are related to supply chain disruptions, plus an enormous amount of inventory stocking as companies try to insure themselves against future disruptions. This strongly suggests that the supply chain-induced inflationary pressure will be transitory. That said, the Fed accelerated its tapering program earlier this month with the onset of Omicron and the expectation of yet more supply chain disruptions, as they removed the word transitory from their policy document. To us, then, the removal of the word transitory increases the hawkish stance, which will then have the effect of increasing the odds inflation will indeed become transitory. Inflation will likely get worse before it gets better, and will also be tied to COVID developments for better or for worse. With the onset of Omicron, one would think that those work-from-home stocks would again do well. These are names like Zoom Video, Domino's Pizza, and Netflix. And by analogy, the return-to-work stocks would be under pressure, names like Chevron, Boston Properties, United Airlines. This trend was certainly the case in the early days of COVID, but the picture gets muddier with each new variant. This conundrum is number 3 on our top 5 list. Many traders have moved beyond what stocks benefit or get hurt by COVID, and instead are moving toward buying the names that benefit when the present wave reverses or in anticipation of the next wave. And some are even revisiting the names that have been overbought or oversold in anticipation of said coming COVID reversal. In other words, traders have moved from what they think to what they think others will think to what they think others think. This process in theory has infinite depth, but in practice usually peters out at about 3 or 4 levels deep. With Omicron occurring so close to the year end, many names are acting in concert with tax loss selling, window dressing, and small cap markups, and other year end phenomenon. One would think that muddy waters will clear as we move into January, but of course, January has its own calendar of seasonal effects. Leadership in 2022 may not be a simple work from home versus return to work theme. Hawkish Fed policy, for example, suggests a decent year for more defensive names, though oversold aggressive growth names seem unlikely to remain in the basement for a second year in a row. So again, leadership in 2022, it may not be a simple work from home versus return to work theme. Headlines are thick about the collapse of Chinese equities. The decline is corroborated with news of Chinese crackdowns on industries ranging from education to social media to finance, casinos, e-commerce, and many more. Military tension in the South China Sea is adding to the aura of fear. Yet amid the headlines, it seems easy to lose track of the fact that the China-Shanghai Composite has actually gained 4% this year. Not super impressive, but still, this is a gain, not a loss. Indeed, the Shanghai manufacturing and mineral sectors are up 30% and 35% respectively. Those are huge gains. Alas, for U.S. investors, without access to the strong Shanghai-listed manufacturing stocks, performance has been less impressive. And for U.S. investors who use custodians like perhaps Schwab or Fidelity that only have access to U.S.-listed stocks of Chinese companies, well, performance in 2021 has been atrocious. U.S.-listed Chinese stocks are down over 45% in 2021 so far. This juxtaposition between Shanghai and U.S.-listed Chinese equities, that's number 2 on our top 5 list. The U.S. appears to be throwing gasoline on this dumpster fire here by adding increasingly stringent accounting and disclosure requirements on U.S.-listed Chinese companies, requirements that China believes threatens its sovereignty. The U.S. is also mandating disclosures that clarify direct and indirect corporate connections with the Chinese military. U.S.-listed Chinese stocks are trading at very low valuations at present, but we are reluctant to take the cheap bait and prefer names listed in Hong Kong or Shanghai. The U.S.-China spat is not likely in the 9th inning here. This slide finalizes our top 5 list of most pressing debates on Wall Street. The chart on the right of this slide is the 3-year performance of the 8 largest stock markets in the world. Which one of these is least like the rest? Well, most markets are up nicely, but the US market in black at the top is simply crushing the rest of the world by about 2 to 4-fold versus most markets. Why is this happening, and can it continue? This is indeed a pressing debate. The U.S. market is generally stronger for 3 reasons. Probably top of the list is the outsized presence of the 5 mega cap tech names, or the FANG names: Facebook, Apple, Amazon, Microsoft, and Google. Those names just dominate the U.S. markets, and there are no other markets outside the U.S. that have such a dominant presence of mega cap tech names. And so when we have an environment, perhaps a work from home environment of COVID, and a name where the technology is still burgeoning in its growth, there's a unique draw to that to the U.S. markets that just can't be replicated anywhere else in the world. Secondly, we do have a situation with a very strong dollar. Now, some of that is flight to safety from a currency perspective as well as from an equity perspective. But when the U.S. in particular sees a strong dollar, and the U.S. economy has an economic setup that benefits from a strong dollar, in particular an economy that is a consumer-driven economy, and consumers do well with a very strong dollar, as does technology and biotechnology. Lastly, the U.S. is doing well partly because of the fact that there are troubles elsewhere, troubles with banks in Europe, troubles with Japan excess debt, troubles with China geopolitics, which makes the U.S. sort of the last man standing. And so add up those 3 reasons, and that does give you a pretty good explanation for why the U.S. markets are doing so well. Of course, this outperformance may soften at some point. It can't continue for forever. COVID may fade, which could broaden the risk appetite for non-U.S. stocks and non-U.S. currencies. That mega cap tech growth may slow at some point, and the challenges outside the U.S., perhaps China geopolitics might get better, or the European banking situation might get better. At present, Cedar River still has an overweight in U.S. equities, but we are always evaluating. This is a pressing debate and something we are watching closely. We've touched on a lot of material in a short time today, but the markets are deep, and there are many themes running at the same time. This slide touches upon 5 more important topics that are relevant to capital markets today. To begin with, number one, both the stock market and the real estate markets are forms of equity, and both benefit from quantitative easing at central banks and a low-rate environment. While the stock market has modestly outpaced most forms of real estate, the returns on real estate are usually levered with some form of mortgage financing that lifts returns to a level that is roughly on par with the stock market. So today we can borrow the phrase from Garrison Keillor that everyone in the stock market and everyone in the real estate market is now above average. Number two, bond rates. Bond rates remain unappealing. Yes, we've been trash talking bonds for most of the last year, questioning whether bonds offer a return-free risk or a risk-free return. With the 10-year Treasury now at 1.45% and central banks increasingly hawkish, nothing has really changed. We still generally prefer cash to bonds. What about commodities? Commodities are still high, though with some variance across the commodity complex. Against a hawkish Fed, there does seem to be most risk amongst the base metals like copper, iron ore, and aluminum. The agricultural commodities like corn, wheat, and soybeans seem least at risk, and oil and precious metals are probably somewhere in the middle. Seasonal factors will remain, especially natural gas in Europe, which has been in the headlines a lot, and lumber. Taxes are likely headed higher next year. I don't think there's much debate about that. Yes, government debt levels have softened a tad, as shown back on slide 7, but they remain at elevated levels. The rules are still in flux, but the direction is not. While there's only a handful of days left in 2021, it generally makes sense to take gains in 2021 rather than 2022, all else equal, of course. Lastly, we touched briefly on South China Sea military situation, but there are other military situations around the world, some of which might flare up into a black swan event. While risks around U.S. withdrawal in Afghanistan seem to be fading in the media, new flashpoints seem to be arising, especially with the Russia-Ukraine situation. At present, though, analysts have yet to adjust earnings forecasts or interest rate projections due to military developments. That concludes our slideshow for today. Thank you so much for listening. Again, please reach out if you have any comments or questions. Our contact information can be found on our website at www.cedarrivercapital.com. We would love to hear from you.